we begin with the most important chart for the markets, because obviously we would start there. That's what Dan Nathan is calling this stock. So, Dan, why don't you walk us through what this is and why it's so important to investors?
Yeah, let's talk about JP Morgan. Obviously, this is a best-of-breed bank. Heading into the crisis, the stock was trading at an all-time high. And, you know, I think there was a lot of investors out there in January who were signaling that this is a chart that's representative of the economy that we're in pre-pandemic. And I just have to tell you, I mean, this thing has acted pretty horrible on the way down. It's down 35% on the year, and that is relative to the S&P 500 that's down less than 10% on the year. So the bounce off of the lows in March in JP Morgan was fairly anemic relative to the S&P 500. And what's important here is that investors seem to be very focused on the stocks that got us here pre-pandemic. That was mega cap tech. We know that it was the MAGA, the Microsoft, the Apple, the Google, and the Amazon, and they're just dragging the S&P higher. But it's the bank stocks that I think are really important to keep an eye on here. I think that they touch a lot of parts of the economy that are going to struggle over the next few quarters here. So JP Morgan breaking that uptrend that's been in place off the March lows. I think you really want to keep an eye on that. So we have best of breed bank acting very poorly. Last week we spent some time on Wells Fargo. Let's call it worst of breed bank. Closed at a new 52-week multi-year low today. I just think the banks are telling you a lot more about what the economy is going to be like in the next few months than the mega cap tech, which we know that they were winners before, and they're clearly going to be the winners out of this thing.
Hi, Guy. Do you agree that this is the most important chart in the markets?
So I don't know necessarily if I agree with that, but since we have a few minutes, since Tim is in the abyss somewhere. So there's obviously a lot of time, and you know I've been a fan of the Netflix, and recently my family and I, they've gotten us into this, the Stranger Things. Are you familiar with that show?
Yes, I've seen the whole
Winona
first
Ryder et al., Matthew Modine. Tremendously say, why are you bringing this up, Guy? Because bring it up for a very specific reason. Right now, you know, above the ground, everything looks great. I mean, incredible the stock market's come back, but the banks right now are, you know, remember the down below or the underneath or whatever they call it on the Stranger Things? That's where the banks are. They're the underneath right now, and they're telling a much different story than the rest of the world, and it's a really scary story. If you had told me when JP Morgan reported earnings back in April that the S&P 500 would continue on this move higher, given that report, I'd say it's a $120 stock. And why? Because they said tangible book is $61. You know, that's a stock that's traded 2.4 times tangible book at one point. I would say 2 is a decent multiple. And here we are at 89. Citibank, by the way, is trading about 65% of tangible book. That is a devastating number. So I don't know if Dan's right in terms of being the most important chart, but I got to tell you something. It's a very important chart, and people should be paying attention.
So let's just be clear. I'm not sure my knowledge of the Stranger Things goes deep enough to carry out this metaphor through this conversation, but does this mean that you think what's going on in the underworld with the banks and their poor performance should be reflective of the markets, or is some sort of indicator of where the markets should be heading?
You know, I think too many people in Hawkins, Indiana, weren't paying attention, and I think... Oh, sorry, Dan.
No, it's called the upside down, Guy, and the market's got this thing upside down for a reason. I just think it's... listen... Right. The point that I'm trying to make here is that this is a name, this is a company that obviously touches a lot of different parts of the economy here in the U.S., but also the global economy. And I'd take it a step further. You know, again, European banks, the Euro Stoxx Bank Index, the SX7E, trades horrible. It's less than 10% from its recent lows here. Go to the Japanese banks, the Topix Bank Index, again, also trades horrible. So I guess the point is that everybody's staring at the same stuff. They're staring at the mega cap tech. They're watching the narrowing of this rally as it gets to this really important, I'm not one of these chartists, this is maybe a Grasso thing, that Fibonacci retracement, 61.8% or something like that, and you're seeing the narrowing of this rally, but the bank globally are telling you something differently. And then when you have a bank like JP Morgan, I think you want to pay attention. That's what I'm saying. That's why it's important.
I get what you're saying about the global banks. At the same time, the U.S. banks are so much better capitalized than the European banks are out of the last crisis. I'm not sure if that's a fair comparison. I get the upside down world thing, though. And BK, I'm wondering, do you think that's an indicator of things to come, a reckoning of sorts for this U.S. stock market? BK.
Oh, you were asking me? You guys doing a live TV show here?
Thanks for joining us, BK. Yeah, dialing in on your CompuServe or whatever you have. Go ahead.
So I heard a little bit about what the banks that you're talking about, but here's the way that I look at it is that you're going to have negative rates here in the U.S. The bond market's already telling you that. So that's not great for the banks. Not only that, you're going to be having quite a bit of bankruptcies and non-payment of loans, auto loans, credit cards, all of that. That's not a great environment for the banks. So the stock market, as we define it, S&P 500 or Dow Jones, can go higher as long as there's people, as long as the Federal Reserve is buying investment grade bonds. But that doesn't mean that the underlying economy, which I think both of the gentlemen on the panel besides me were getting at, doesn't mean that the underlying economy is that great.
So, Guy Adami, it is possible to have MAGA go higher, but the banks continue to trade lower. So does that mean you just go with it?
Yes, absolutely. And I think most people would agree. I'm not saying it's correct. I'm not saying that it should happen, but it's absolutely happening because, once again, it's incredible the complacency that's found its way back into the market after, the market's seemingly impervious to everything that's going on in the world. Look, again, I'll say this. I understand what's happening. I understand money flows and what have you, but I don't think people are paying attention. And right now, the NASDAQ is more expensive on a valuation basis than it was when it was making all-time highs, as is the S&P 500, which may be okay when the Federal Reserve is basically throwing money away willy-nilly, but quite frankly, it should scare a lot of people. So, I agree with Dan and BK in terms of the banks and what they're saying, but it doesn't mean that some of these stocks can't continue on their merry ride. And that, in fact, is, I'll go back to it. It's Stranger Things. It's Hawkins, Indiana. It's Winona Ryder's resurgence. It's all those things wrapped up into one.
Speaking of Stranger Things, Tim has joined us. So, Tim, do you want to weigh in on this conversation?
That's a fantastic segue. It's a good thing I was listening in because this could get pretty uncomfortable. So I know what you're talking about. And I think if you look at, say, the Russell 1000, if you look at the growth stocks, they're trading at about 25 times, and value stocks are trading at about 18 times. So, again, you have 7 turns, which have basically doubled in terms of 3.5 turns in the last 3 to 6 months. And I think this is going to continue. If you look at growth over value, or secular over cyclical, or, Main Street, Electric Avenue, Eddie Grant, that's digital. This is a case where why wouldn't these trends continue, as uncomfortable as it is, the crowding into MAGA? So it's hard to dispute banks. Dan's been right. His chart makes sense to me. I do think that banks are being priced for more reserves. And the good news is I don't think that there's going to be equity dilution in banks in the world that I see right now. And I think the market, unfortunately, has to go with the credit unknown. And that is going to be to punish banks.